Last month, late to a dinner downtown, I found myself hailing a cab. And it seems to me that there are two types of cab drivers, those who have a lot on their mind and want to share it with you, and those who don't. And this was very much the first type of cab driver. As I settled into the back of the cab, he said to me, "What do you do?" I said, "I'm in the investment business." And he said, "Terrific, I've got 20 minutes of your captive attention to run some ideas by you." And there was a lot of detail that followed, but what it boiled down to was that he had a surefire way to generate 25% annualized returns in the stock market. I said, 25% returns? That sounds very aggressive. How on earth are you going to do that? And he said, it couldn't be simpler. What you do is you take Google and you find the 5 best performing mutual funds of the prior 12 years. You sell everything that you have. You put 20% into each one of these funds. You wait a year so you get long-term capital gains, and then you just repeat the whole process. It has worked so well this year. My wife and I are going to quit our jobs, move to Thailand, and ride motorcycles. What do you think? And I had a lot that I thought about it, but the cab had pulled up in front of the restaurant, and what I had time to tell the cab driver was, I'm very worried about your strategy. I'm worried it's not going to work, and I'm worried about you. It's too bad, because I'd been spending a lot of time thinking about what makes markets irrational, and I had a lot to say to him, and I wish I'd had more time. Now, markets, I'm a big believer in markets. They're an amazing invention of our civilization that get done some things better than any other way we've figured out how to get them done. They discover prices, they allocate capital to businesses, they provide for the retirements of millions of Americans. Markets have always been irrational. How could they be anything other than irrational? They're made up of human beings, and rationality is not uniformly distributed across the human condition. But Mr. Market is more irrational than normal these days. And what I'd like to talk about this morning is what is making him crazier, how to profit from it, and maybe how to help other people profit from it. After 17 years of being a stock picker, it seems to me that there are two challenges facing a stock picker. The first is how to generate great returns, and the second is how to actually deliver those great returns to other people. You would think that solving the first challenge would make the second challenge easier, but you would be wrong. And that is because the strategy that is most likely to solve the first challenge is one that is rejected by the majority of people. That strategy is called concentrated value investing. And of course, it's not a novel strategy. Warren Buffett is a patron saint of an entire movement of investors who has used this strategy to create vast personal wealth for themselves and for their clients. But the vast majority of people reject this strategy. If you define concentrated value investing as having the courage of your convictions to have even a single 5% position and to own rather than rent what you own, defined as less than a 30% annual turnover, one estimate is that just 1% of the global publicly traded equities out there is managed using a concentrated value strategy, or about $800 billion. And interestingly, of that $800 billion, 40% of it, about, is managed by Warren Buffett, the patron saint himself. When you see something demonstrably superior rejected by 99% of people, it kind of looks like madness. And when you see madness in the world, it's a good idea to ask yourself, why is it happening? I think the reason that it is happening is volatility. Now, people want equity returns, but share prices are volatile. And I don't mean volatility as defined by the VIX index. It's a perfectly usable and understandable measure of volatility. I mean a different measure of volatility. In 2004, as I was starting Oakcliff, I was lucky enough to find myself in a room with about 24 other aspiring stock pickers and the great Warren Buffett himself. And we took that occasion to pepper him with questions, all of which boiled down to the simple question, how do we become like you, but faster? And he broke to us the bad news that value investing and stock picking is a long game. But, he said, I do have a piece of good news for you. The average share price goes up and down by 80% in a year. That is a wonderful tailwind for a stock picker who's actually done the work to understand the underlying business. 80% in a year, I thought to myself, he's obviously lost his mind. So I headed home, got out a copy of Value Line and did the calculations that he was suggesting, which was to compare 52-week high to 52-week low and see the percentage difference between them. And, maybe not surprisingly, because he is the sage of Omaha, he was not wrong. You can see on the left side of the screen examples of the calculations he was talking about. I've chosen here 3 companies: 3M, Walmart, and Google. These are big companies. I don't know how many analysts and investors follow them, but it is many, many, hundreds, and hundreds of millions of people use their products and services. You would not think that their share prices would be volatile. But in the calm year of 2019, these share prices varied by between 33 and 46%, and in the pandemic year of 2020, by between 51 and 82%. Take 3M as an example. 3M makes Scotch tape and Post-it notes and is headquartered in a suburb of Minneapolis. These are not factors associated with volatility. Now, when my partner John Jemgochin, who's sitting over here, joined Oakcliff, he heard me talking about this kind of volatility, and he thought to himself, Bryan has lost his mind. And being a reasonably numerate person, he used Bloomberg to download this information not just on 3 companies, but on all 2,500 companies in the S&P 500 and Russell 2000 going back 20 years. And he used a computer to calculate the median volatility, so defined, for those companies. And the answer is in the slide on the right. And it was as astonishing to him as it was to me back in 2004. Median volatility for the U.S. stock market, these companies are like 98% of the value or something like that, of between 40 and 60% in a calm year, and in a crisis year, like the 2000 dot-com crash, or the 08-09 financial crisis, or the 2020 pandemic, of approaching 200%. Buffett turns out not to have been very far off with his estimate of 80%. He's basically averaging the calm and the crisis years. But think about what this chart means. This market that we rely upon for these important things, allocating capital to worthy businesses and providing for the retirement of Americans, is crazily volatile. And there's a fair bit of evidence that this volatility is hurting people. Volatile share prices mean volatile returns to people. Many people do not like volatility, and they respond with fears that are deep-seated in human psychology. Share prices falling lead to fear of loss. Share prices rising lead to a fear of missing out. People manage these fears with their investments by doing what they feel is within their power. They hire and fire managers. Like that cab driver, they fire people who have underperformed and hire people who have outperformed. Unfortunately, this activity, buying high and selling low, results in damage to their investment returns. Dalbar has compiled the actual money-weighted returns realized by investors in all of U.S. mutual funds in the decade. You could do this for many decades. I've just chosen the most recent one, 2010 to 2020. The result of this activity was a 4 percentage point reduction in the results actually realized by clients. 4% a year is a big number. Measured out over a 30-year investment horizon leading to someone's retirement, that would be a 70% less of a nest egg to retire on. How proud should we be of a market that is delivering results like this to clients? And in a society that right now is convulsed about questions of wealth inequality, in which we've democratized finance, we've said these defined benefit pension plans are not really going to be the answer. We invented the 401k in the 1980s. We invented the IRA in the 1990s. Democratization of finance basically means you're on your own to manage your own retirement. Does this data suggest that that is working? And making things worse, active managers don't like to be fired by clients. And they respond by diversifying their portfolios to dampen the volatility. The average mutual fund manager owns 185 securities. Who here believes that a money manager can understand the details of 185 businesses all that well? And who here is surprised that active managers don't perform all that well? But if you concentrate into your best ideas, like Buffett advises us to do, and you're in the wrong structure, you can cause a lot of damage to clients. A painful example is the CGM Focus Fund. It's reported, Morningstar, Wall Street Journal, This was the best performing mutual fund of the 2000s. Concentrating into 20 stocks, it delivered an 18% compounded return, which is just a terrific result. But those returns were volatile, and clients responded with those deep-seated fears. The result, a 29% reduction in the returns they actually experienced to an 11% annualized loss. On an investor-weighted basis, $1 going into this fund was 30 cents at the end of the decade. How on earth is that a good outcome? The response of many people to these poor results from active investing is to shift to passive investment. It's completely understandable. ETFs and indices are now half of fund investment in the U.S. Equity markets, and I think looking out over institutions and how they're allocating to equities, it's pretty obvious that passive strategies are about half of the U.S. stock market. Robots have been hired to do this job on a very diversified basis. Hiring robots to pick your stocks is a great way to lower fees. It's probably a good way to reduce anxiety, but it's a certain way to get average performance. So how do you do better than average? I believe the way to do it is a concentrated value strategy. But whether you're a client or a manager embarking on concentrated value as your strategy, you have to remember the iron rule of underperformance. No one doing this, there's one small exception, it's Buffett's first 15 years as a stock picker. Okay? With the exception of those 15 years Buffett put up in the beginning of his career, no one attempting to beat the market does not have long periods of underperformance. Beating the market is not easy. And a client attempting to decide whether or not a stock picker is going to be able to do it, I believe that client should be asking some questions. The first one, what is your long-term track record? Are you talented or just lucky? One of the most dangerous things in money management is a stock picker with a good 5-year track record. If you give 100 kindergartners quarters to flip, 3% of them are going to get 5 heads in a row, but that does not make them good stock pickers. Second question, are you aligned with me? Are we on a journey together, or are you just gathering a lot of assets to charge a lot of fees? Do you have a lot of money up in this joint project of ours? And finally, what is your strategy, Mr. Stockpicker, to help me, the client, manage through the volatility that is going to result from your attempt to get above average returns? Almost every money manager complains about client anxiety, but very few of them have a plan to address it. When I started Oakcliff 17 years ago, I had no such plan to address it. My role model, my inspiration, was a man named Shelby Davis. In this small world, his grandson, Chris Davis, an old friend of mine, is sitting here in the audience with us. Not a lot of people know about Shelby, but he did do something amazing. Starting in 1947, with $200,000 of his wife's family's money, he compounded that money, never taking a dollar of outside capital, to be $800 million by the time of his death, a 4,000 to 1 return, 19% annualized. How did he do this? Shelby began his career as the insurance inspector for New York State. And insurance companies are interesting creatures. They report a lot more information to the states that regulate them than to the SEC for publication in an annual report. All of this information was publicly available, but Shelby, because he was the insurance inspector, knew where it was and what to do with it. Concentrating his early investments into a small number of insurance companies where he had an informational advantage, he paid good entry prices and used share price volatility to buy low and sell high. He solved the first challenge, how to get great returns. He avoided the second challenge, how to deliver those returns to other people, because he never took other people's money. We're trying to follow in Shelby's example at Oakcliff. I started it with $6 million of family money 17 years ago. We concentrate into a small number of stocks. We currently hold 11. It's ranged between 10 and 15. We're trying to get to Shelby level of understanding of the underlying businesses. We focus on what we call great businesses, by which we mean businesses that have durable cash flows. And the durability of those cash flows means that intrinsic value out in the future is more predictable, especially more predictable than their share prices, which are volatile. Every so often, a crisis of confidence engulfs a great business. 2 examples. 4 years ago, as Verizon, AT&T, and T-Mobile rolled out the idea of 5G to get you to buy a new cell phone, investors worried that 5G would disrupt Charter's fixed broadband connections. We did a ton of work on the physics and economics of 5G, determined that the worriers were wrong, bought a lot of Charter stock when it was depressed, and have done very well. 3 years ago, Carvana was delighting customers. Sky-high net promoter scores, very few cars returned, early profits in early markets. Investors worried that the father of the CEO was using affiliated insurance companies to buy Carvana's finance receivables at inflated prices and thus goose Carvana's sales and its share price. We went to the records that the insurance companies had filed with the states, were able to see how that finance paper was performing on the books of those insurance companies, and determined that this was some of the best performing paper that the insurance companies owned, and it was some of the best performing paper that any used car retailer had ever originated. It turns out honest and transparent pricing for consumers results in really high performing paper. The worriers were wrong. We bought low and have done well. Volatile share prices for us are not something to be feared, but rather, when we have an informational advantage, an opportunity to buy low and sell high. Jim tells me that a successful grants presentation has a stock tip, and this is a summary of the work that we've done on the most recent thing that we bought. We bought this back in January. BFIT is an operator of gyms in Europe, low-cost gyms. They charge you just 20 euros a month. They're the leader in France, the Benelux countries, and Spain. Low-cost gyms turn out to be really great businesses. They fulfill a couple of needs. One of them, obviously, is healthy bodies. The other one is social. You are much more likely to meet a date for Saturday night on the bike next to you at a BFIT than pedaling at home alone on a Peloton. Also, low-cost gyms turn out to be winner-take-most businesses. If you build out a chain of low-cost gyms across a city or a country, you create a barrier to entry that makes it very difficult for new entrants to enter. We see this in several countries, and once the winner is established, cash flows are dramatic. In the United States, the winner is Planet Fitness. Cash flows are dramatic. It's up 500% in the last 5 years. We believe BFIT is the winner in much of Europe, and that the stock is cheap due to lingering concerns over the pandemic closing gyms. We bought it at 30 euros a share. We think it has 3 euros a share of earnings power once the current gyms mature, which takes about 2.5 years, and if they can build the gyms that they say that they can build, we think that it is trading not at 10 times what we paid for it, but at a single-digit multiple out in the future. Investing in companies like Charter, Carvana, and BFIT when their share prices are beaten down is how we've been trying to solve the first challenge. We've done very well over our first 17 years, and we have another 30 years to see if we can match Shelby's 4,000 to 1. We will be very happy to have a near miss. But we have accepted clients, and so we've had to think about that second challenge, how to actually deliver those returns to other people. Why have we accepted clients? Beginning with back in 2004, I would write letters every 6 months about what was happening with our investments, what the decision-making process was like. These letters were meant to organize my own thinking. Also, I had left a big job to start Oakcliff. People were curious about what I was doing. And I would send these letters to people who had helped me think about some sort of investment process. When someone you admire asks for you to manage their money because they trust you, it's difficult to say no. Also, resources from clients have meant resources to conduct investment research at a more intensified level, which I believe has improved our returns. But those returns have been volatile. In 7 out of the past 17 years, we have underperformed the S&P 500, and yet measured out over time, we have widely outperformed for our clients market indices. So we've had to think of things to help other people through these periods of underperformance. Here are some things that I think stock pickers might think about. The importance of setting clear expectations. Underperformance is going to happen. If either the manager or the client does not think it is going to happen, there has been miscommunication, maybe misleading oneself. There has to be clear expectation that that's going to happen. Second, there has to be confidence through honesty of communication, through alignment by each side having a lot of money up. This is a volatile path, hopefully up and to the right. If there's not confidence by each side and the other, client and manager, it is going to be a very bumpy ride. And finally, very important to help clients think through their own psychology of money. How do we get people to put an investment in a volatile strategy like concentrated value investing into a psychological place that says long term? What's the percentage of their net worth that they should have in this strategy that they can bear, see go up and down? Maybe there's a lockup that can help them say, really, that is long term. That's off to the side. Choices like this seem to have helped our clients, and we're very proud to have delivered good returns to them through the several market downturns that we've had since 2004. So, Mr. Market. Everyone in this room knows about Mr. Market. At Oakcliff, we love this guy. The crazier he is, the more he presents us with opportunities to buy low and sell high, the more money we make and the happier we are. But he's crazier than normal these days. Superficial level, I'm not sure what Michael Lewis will work on next for his book, GameStop or the meme stocks. Both are filled with opportunity for a great book. You can buy financial instruments that almost certainly are bad for your health on Robinhood, and yet you get showered with confetti, so that's not great. But at the core, a supposedly efficient market is actually amazingly volatile. And clients react to that volatility with those deep-seated fears, hiring and firing people at the wrong time. The managers don't like being hired and fired, so they diversify into investments they don't understand. They're more like renters than like owners. This movement of people into passive investing, hiring robots to do this job, I think risks being a good idea taken to an extreme. Robots mechanically buy high and sell low, and renters don't know what they own. I think this feels like a bad feedback loop. And it's very rational for a stock picker to avoid that second challenge. How to help people with this market. The dream of many, if not most stock pickers, is to actually fire the clients and run a family office, like much less agita, or set up an insurance business and invest from a base of permanent capital. But I think there is another way. You can invert the problem. Don't frame this as a question of client anxiety. Frame this as a question of stock picker responsibility. Acknowledge the anxiety that other people have. It's their money. It's going up and down. They don't have the time or the inclination to have done the work to understand the underlying businesses. A stock picker should ask himself or herself, what is my strategy to reduce client anxiety? And everyone in this room and on this webcast has been lucky. We're all beneficiaries of this amazing market system. It's created massive wealth for a few. Oakcliff will do just fine in this market. Maybe, arguably, the crazier the better. But what is the responsibility that we have to other people to help them with this market? And shouldn't a stock picker have an answer to both challenges? Thank you, and I'd be happy to take questions.
Hi, one question for you. It's about dealing with the compensation and fees for the external money that comes in. So we have a family office. Every now and again, people are like, oh, we want to put money with you guys, et cetera. And then when we start talking about fees, inevitably they talk about performance fees or management fees, and it's often relative to some kind of index. And I'm like, well, we don't do relative to index investing. So what kind of fee-based or compensation structure have you come up with that works with your investment horizon and process for your external clients?
Yeah, no, it's a good question. You can buy an S&P 500 index fund for, 10 basis points. I don't even know what the price is, but that's the price of average performance, right? And you can hire a wealth advisor for, 50 basis points, 80 basis points, 100 basis points. We happen to charge a 1% management fee and 20% over 6%. The old Buffett strategy was, or the old Buffett fee structure was 0% management fee and 25% over 6. We live in Manhattan, okay? So I think the need for a little bit more management fee to pay for the ruinously expensive life on this island. But the outperformance that we have delivered over time, about 40% of it has been eaten up by our fees. So the outperformance over the index, that's the other way we think about it. The outperformance over the index, we've delivered about 60% of that to our clients, and 40% of it has been the cost of us delivering these returns.
Have you been, over here to your left,
Yep.
Have you been able to maintain your discipline in your concentration? And what happens, like, how do you make your decisions to get out of A and go into B, or out of 12 stocks or 15 stocks, and because you're probably looking at hundreds all the time?
Yeah, no, it's a good question. We look at about 100 stocks a year in some detail and turn on the afterburners on maybe 10, which is really a pretty intensive process of trying to learn everything possible, like investigative journalism. This year we've made one purchase. Now, we have 11 things, and everything that we own, we have an estimate going forward of what we think it's going to do for us, the shareholders, in terms of cash flow per share. And of course, estimates are wrong, particularly about the future, so said the great philosopher Yogi Berra. But projecting that stuff out gives us an expected IRR. And in order for us to start investing in something, we need like a 25% IRR. And in order for us to start trimming something, it's got to be dropping below the teens. We hate taxes. So it is numerically based. And what John and I are doing is just madly working. It doesn't look like it. It looks like a library. But we're madly working all the time to add that 12th idea. And we're sitting on a bunch of cash.
With respect to client anxiety, you can spend an awful lot of time trying to lower client anxiety, and it has so many inputs these days that they'll argue with you about. What do you find are some of the key characteristics of successful clients that will take your advice, and what are they like, the actual great clients that come with the same amount of dollars as the ones that aren't so great?
Yeah, some money managers say, clients are a commodity, it's their money, but, we're the smart people or whatever. I think the right set of clients is actually a huge competitive advantage. Smart clients who understand what you're doing and appreciate the value of the value of what we know about businesses actually goes up in a crisis. The current IRR on what we own is in the high teens, right? In April of 2020, it was in the mid-20s, right? So if you have clients who understand the volatility and who understand the opportunities posed by it, it's a tremendous gift to have people. And I think, you get the clients you deserve. So I think if you communicate clearly and you tell them what the game is and you have a lot of your own money up, you ultimately collect a group of people who are on this shared journey together. And I think it's a massive advantage to have clients who understand this.
So, Bryan, we just wrote about somebody in grants who shut down his fund. This was in Europe, on the basis of his reading of the investment environment. He couldn't find anything to do, and took the example of Warren Buffett in the mid-'60s and said, "No, thank you, not for me."
Yep.
What would it take, if anything, would lead you to take that decision?
Yeah, I think if we didn't have a portfolio discounting an IRR in the high teens, Basic Fit, when we bought it, I think was discounting something in the mid-20s. Like if we went through some sustained period of time where we couldn't find anything else. Also, we're smaller. Like our opportunity set, the number of people who do what we do seems to be shrinking, but it seems to be shrinking. The SPOs of the world, they get to $5 billion. They can no longer do it. Their founders are rich. A 10% position out of a $5 billion fund is $500 million. Therefore, if you're just going to be 5% of the company, it's got to be a $10 billion market cap. You've just cut off like 90% of the addressable market. So there's a sort of a life cycle of this. Founders make money. Their opportunity set is limited by the size of their AUM. They stop. Okay, we're sitting here at $300 million. Like there's very little we can't do, and we seem to be able to find still investments. It's a little frustrating. It's been 9 months since the last one, but we keep getting close. So the market is kind of crazy, but we bought Basic Fit at 10 times earnings. There's another one out there. We'll find it.
might be the source of lunacy in this market is the absence, virtual absence of interest rates. Like there's no gravity, right?
Yeah.
And we've all gotten used to that. We've had 10 years sensibly in the absence of interest rates. I exaggerate slightly, but not much. And you get anesthetized to this singular state of being in finance. So are we perhaps all not a little complacent about what might happen in case the world decides that inflation is persistent, the central banks are behind the curve, and that rates are going up in such a way as to destroy one's preconceptions of what an IRR is on the basis of 10 years of very complacent experience?
Yeah, I mean, I hear that, and it manifests itself at Oakcliff in a debate over what the terminal yield should be, and should that be 6%? Should that be 5%? Should that be 7%? I really respect conversations about macro and about interest rates. I think they are super important because in the end, macro matters. Charter is our largest position. They pass 52 million homes. They're connecting something a little bit more than half. They're going to connect 70%. It's somewhat inevitable. They're charging 60 cents an hour for entertainment. Find me another form of entertainment which you can do for 60 cents an hour, or try to turn off your Wi-Fi if you have teens and see how well it goes. Like if they said to you it's 90 cents an hour, I mean, people would squawk. What would they do? Okay, so in the inflation that you're talking about, and we're doing this a lot, like what is the ability of this business to price in excess of inflation? Basic fit is 20 euros a month. Would you squawk if it was 21 euros a month? 22 euros a month? That Peloton, way more expensive. So your question is right. I think a lot of this macro stuff, it's so important to get right, but it's an epistemological point. Maybe that's kind of a $2 word. We find it easier to focus on the things that we know to be true. You cannot turn off your Wi-Fi. There is no alternative. Elon Musk is trying, but so far the physics don't work.
Okay. Is that it? Have we exhausted the curiosity?
I guess I have.
Bryan, thank you. That was very terrific indeed.
Thank you.